Moving on to our next speaker, Mr. Pradeep Singla. He is an IIM alumnus having more than 14 years of experience in options trading, more than 8 years of experience in providing trading in option trading strategies and adjustments. He left a high profile corporate job and became a full time trader. He is the co founder of the Option School, having a popular YouTube channel by the same name, extremely specialized in creating unique adjustments in option trading strategies. He is also a faculty for NSC Academy and has done many workshops jointly with NSC Academy. He will be speaking on practical usage of Greeks. This session will be moderated by Mr. Raghunath Reddy.
Hello guys, welcome to EDECNOCH 2021. Today we are going to do another option session, and today we have esteemed guest Mr. Pradeep Singla, who is going to talk about practical usage of Greeks and how you can use the knowledge of Greeks in managing your option trades, mainly from the perspective of delta neutral strategies. Now let me briefly introduce Mr. Pradeep Singla. Now, he's a very experienced person when it comes to options trading. He is an IIM alumnus having more than 14 years of experience in options trading. And he also has more than 8 years of experience in providing training in option trading strategies and adjustments. He used to work in high profile corporate jobs and then he quit them and became a full-time trader, and he co-founded the Option School, which also has a popular YouTube channel by the same name. He is extremely specialized in creating unique adjustments in option trading strategies. He is also faculty for NSC Academy, and he jointly conducts workshops with NSC Academy with many of the new traders as well as experienced traders. So we are very glad that Mr. Pradeep Singla has accepted to join us and share his knowledge with the attendees of EDECNOCH. Uh, and I've known Mr. Pradeep for a couple of years, and I've been following him and his YouTube videos where he shows different kinds of adjustments with different option strategies. And he also talks about psychology of trading options, which I think many people don't talk usually. But today, so we'll talk about practical usage of Greeks. So welcome, Mr. Pradeep Singla, to EDECNOCH 2021. Uh, do you want to add anything from your side? Did I miss anything in introducing you?
So nice of you, Raghu. I think you have already over glorified my profile. In fact, it's not you are following me. I am following you in your Twitters and YouTube channels. Right. So it's a mutual admiration both of us have for each other. I really love your OPSTRA, and OPSTRA has made things so easy for most of the traders. So I'm a big fan of OPSTRA and Raghu.
Thank you. Thank you. Thank you. So, so we can start the presentation, and you can talk about what you're going to share with us. And then in the end, if there are any queries, I will ask questions in the end.
Okay. Shall I start now?
Yeah.
Okay, we will be talking about practical usage of Greeks today. We all know, most of us nowadays know what are Greeks, right? But when it comes to, I have so many participants with me in different workshops. When I ask them, do you know Greeks? People say, yes, we know what is delta, we know what is theta, vega, gamma, rho, everything we know. But my next question generally is, do you use them in your training, in your trading? And then mostly people say no, although we know a little bit of Greeks, but we really do not know how to actually practically use in our strategies. So we said, okay, let us today discuss about how to practically use the Greeks in the trading strategies, and we will be doing it through a very simple but very good case study. Now, if I am talking about when to use Greeks, so I'll say there are two kinds of option trading strategies. There are open trades and there are closed trades. Open trades means like short strangle, long strangle, short and long straddle, naked selling of calls and puts. Now these open trades means they are not hedged. They can give you unlimited profit, they can give you unlimited loss. And then there are closed strategies, closed trades like butterfly, iron butterfly, condor, iron condor. Now when it comes to Greeks, when we are into closed trades, automatically these closed trades are very well hedged compared to a situation where we are having an open trade, especially an open trade which is like short straddle or short strangle, which can give us unlimited loss. So importance of uh, uh, too Greeks become too important when we are coming to unlimited loss kind of strategies. But again, that doesn't mean that the closed trades do not have value in using Greeks. Closed trades also have, but then again, closed trades, since they are intrinsically hedged, so we can definitely give a pass to Greeks at least in closed trades. But open trades, definitely it's a must if we want to do trades like short strangle, short straddle. And risk is not defined in open trades. Risk is not defined in closed strategies. Since risk is defined, it is easier to manage the trade. In open strategies, it's always difficult to manage the trade when especially market move here and there. So what happens, Greeks provide us a beautiful method to handle the trades, which is very mathematical. It's not that okay, you are required to predict the direction of the market. Basically most of the traders like me who are delta neutral traders are direction neutral also. So we do not try to predict the direction of the market, that okay, market from here will go up by these many points or go down by these many points. So in those cases, when to adjust, what to do in case market is swinging in one direction, Greeks provide us a very good handle on how to manage these kind of situations. Because obviously if you're an option seller, you want markets to be as stable as possible, but then markets may not oblige all the time. Many times market will make different moves, right? So in most of the selling trades, strategies are dependent on three parameters in options trading. First is how the market is swinging. Suppose I've sold a call and market, instead of going down, is going up. So that creates problem. That swing of the market, the direction of the market will create problem for my position. Second thing is what is happening to the volatility of the market. We have seen market at the same level. If volatility is high, the premiums will be high. Suppose I am an option seller and after I have sold the position and after that volatility increases, obviously I have to see some kind of a negative MOM. And in case I'm an option seller and once I have taken the trade, after that volatility decreases, that means it will be good for me. So volatility increase means premiums will increase, and option seller do not want premiums to increase. So volatility also have a good impact on position, at least on day-to-day basis. On expiry basis, yes, uh, anything which is out of the money or at the money will become zero. But it's not only expiry. We have taken the trade, and especially if we are talking about a positional trade, it's not that okay, you have taken the trade and next day expiry is there. So there will be a gap of 10 to 20 trading sessions, and during that market will swing. There will be volatilities and increasing volatility, increasing, decreasing. So it will cause a lot of psychological pressure if we do not have a proper control on the situation. And obviously the third thing, most of the option sellers love it, most of the option buyers hate it, which is time decay, which is represented by one of the Greeks. So how much time is left in the series? That also is the third most important factor in the options trading, right? So now most of the traders, thanks to a lot of material available on YouTube, thanks to a lot of material available on Google, most of the traders understand that okay, there are three Greeks. One is delta, which talks about swing sensitivity. Another Greek is vega, which talks about volatility sensitivity, and there is theta, which talks about time sensitivity of the trade, right? All these things are uh, there. So delta basically tells you by how much the option will move up and down with your trade with the underlying moving up and down. Vega tells you how much the price of the option will change with respect to increase or decrease in the implied volatility, and theta tells us with as time passes how much is the decay on daily basis. Most of us understand these things. Now beyond this, when it comes to the adjustment of strategies, that time it's an issue. Now challenge lies in challenge is not that okay, do I understand what is delta, what is theta, or what is vega. Challenge lies, do I even after understanding these things, am I able to use these things in my trading? It's like I know there is a bicycle. I know you can sit on the seat and you can hold the handle and you can ride the bicycle, but whether I can actually do it or not, so there is a slight difference between knowing and actually doing it, right? Unless and until I sit on that cycle and I start learning how to balance it, I just know theoretically that okay, there is a cycle, there is a bicycle, and you can pedal it, you can hold the handle. But when you actually sit on the seat, then only you come to know yes, there is a little bit of skill in riding it properly, right? So that's what I'm saying. Knowing that okay, what is delta, what is theta is okay, but then what to do after that? Today we want to talk about those things. What is the interpretation of these values for your actual trade and application of Greeks in actual trade adjustments? As I said, most of these Greek values when you take the trade will be different, and when market moves will be different. So how will you adjust your trades through adjustments in Greeks, and what is the right decision making based on these values, and what are the repercussions of all these decisions? We will be talking about many of these things in our case study, right? With the help of this case study, we'll try to understand the right and the practical usage of Greeks. Now let me give you some coordinates of the case study. Let's say again, we have taken the data as realistic as possible, so there may be a little bit of estimation here and there, which is just to make the understanding easier. Now there is a trader, Mr. A. He has around 9 lakhs of capital and he has taken these positions in the market. Market approximately is 17,300. Margin consumed is approximately 8.12 lakhs. Out of 9 lakhs, he has used 8.12 lakhs in the positions, and balance he would like to keep as a buffer, so that in case there is some negative MQM, that can be taken care of. So what are the positions he has taken? He has taken these positions. He has sold a call and he has sold 8 lots of it, minus 400, and simultaneously he has sold a put also. So he has used a strike price of far out of the money for call, which is 17,800, and he has used put of 16,900, and my lead market is somewhere close to 17,300. I don't know what are the prices, right? So let's say we know what is the delta for 17,800 call, which is 20.7. Actually, it should be 0.2007. Generally, we write it as 20.7 because delta value is 0 to 1, but generally you multiply it by 100. And then we have theta value, and then we have calculated what is total delta, total theta. Total delta is basically whatever is the quantity sold minus 400 into this delta should come to this, because delta is multiplied by 100. In the total delta we have divided it by 100, because delta value actually we want to take is 0.20, but we do not want to miss on the last two decimals, so that's why generally 20% is taken as delta. So since it's a percent, so we take it minus 400 into 20.07 minus 80.28. Similarly, minus 400 into minus 3.08, it gives us the delta total theta value also, which is something close to 1232, right? And similarly on the put side, 16,900 minus 400 into minus 18%, you can say it gives me a value of 75.32, and then similarly minus 400 into minus 3, minus becomes plus, it gives me 1440. So for the whole trade, what Mr. A has taken when market is approximately 17,300, for the whole trade his total delta is minus 4.96 and total theta is 2636. right? He could have some more positions also. He could have some more, like maybe 17,600 calls sold, 17,300 puts. So ultimately we will still find out that okay, there is one position Greek which is the final value of the overall set of positions in single underlying, right? So we are talking about Nifty here, and total delta is minus 4.96, total theta is 2636. Now once he has taken these positions, now you can see we call it health of trade. If you know what is delta, theta, vega, gamma for the trade, you can come to know just by seeing the trade that okay, 4.97 is delta, this much is theta. I know okay, I'm going to get this much of decay every day, right? So and this is the swing, how much the swing can impact me is given by this. So this is a screenshot we have taken from for the similar kind of a trade from OPSTRA. And if you can plot your positions in OPSTRA, you can just put your positions in OPSTRA and you will immediately come to know how much is the margin required, which is very close to the real margin. Then you have how much is the delta, how much theta, how much is vega for the trade, right? Only thing is we must always select Greek in rupees so that the values are getting multiplied, right? So, and this shows max profit also, this shows the break even range also of the trade. So how to get it? Many times this is the question, how you have reached to this number of minus 4.97269. With availability of software like OPSTRA, this has become very easy. Otherwise, we used to do all these things in an Excel sheet manually, as good as manually, right? So now you have this real time, and these things change real time also, which is the biggest advantage. So we have checked the, like if you're checking a health of a human being, you see that okay, what is his blood pressure, what is his sugar level, what is the stress test level, and all those things. So this is very similar to that. For checking the health of the trade, we need to check what are the Greeks of the trade. Once you know the Greeks of the trade, everything becomes you know that okay, whether this is a healthy trade or not. Now any trade which is healthy at a particular level can become unhealthy as soon as the market uh, changes the uh, level from where it was created. If this trade was created at 17,300 and market goes up, now in this case also we have seen that okay, very next day, let's assume markets went up by 150 points. So his trade was delta neutral when markets were at a particular level, but markets are markets, they will always move. So what happened very next day, market went up by 150 points. Again, this kind of a move is never a desired thing by an option seller. Now because market has moved by 150 points, what has happened? Some delta on the call side has increased, some delta on the put side has decreased, and ultimately position is no more delta neutral, and we need to again bring his position to delta neutral. And what can be the best way to do that? As we said, okay, we want to learn how to use it, right? How to use this information. So let me show you. Okay, when market has moved up, the call delta has changed, the put delta has also changed. Because their values have changed, now they are not able to balance each other. Can we see that? Now the total delta on the call side is minus 118, whereas the total delta on put side is only 54. So this is no more a delta neutral trade. This definitely is a dangerous trade. If I'm saying, if I'm assuming that okay, other things do not change very fast, if market from here move by another 100 points, and I'm not at all considering any gamma effect, I'm saying if market from here goes up by 100 points, it will give a loss of 100 into 64.5 to 645 to loss, only because of swing of the market for this trader, which is not a right situation to be in. If you see the beginning of the trade, his delta was only minus 4.96. So even if market from here moves up by 100 points, we are still, I'm assuming that okay, there is not much increase in, there is no much impact of gamma. So then he will be losing hardly 496 500 rupees, which is okay, right? But in this case, now the position definitely is not okay. Minus 64.52 is very high. So what we need to do is we need to bring this position again to almost delta neutral. Why I'm saying almost delta neutral? Because again, we are not looking for exactly zero delta. Generally, as a trader, you look for a slightly negative delta, because in case markets go down, whatever is the Vega impact, because if markets go down, generally markets will generally the VIX will go up, so Vega will be having a bad impact on a trade. So that bad impact generally gets nullified by a little bit of negative delta, and in case market goes up, whatever is the bad impact of negative delta, that gets nullified by reduction in VIX. So Vega impact and delta impact generally get nullified, and ultimately theta is what you get into your pocket. So generally we try to keep slightly negative delta rather than making it exactly zero or positive. So let us see what are the best ways to uh, neutralize this delta, right? His initial position was this, and after the market moved by 150 points, the health of the trade, I'll say the health of the trade deteriorated after the market has moved. Obviously that will happen. Market has given a decent move of 150 to 100 points. So now this is not looking a very healthy trade. So initial position minus 4.96 only, and total delta now is minus 64.52. Theta is still comparable, almost similar. So there are multiple solutions available. Now here comes the problem that okay, we know how call delta behave, we know how put delta behave, we know how selling puts behave, how selling calls behave, and now when actual situation comes in the market, here we have now multiple options. We have multiple options to neutralize this trade. As an experienced trader, we need to know which option, which solution is good and which solution is not so good, and what is the problem in different solutions. So let me give you a few solutions. You can also think of few solutions, and let me, because of my experience in this, because of a lot of workshops we have done, I'm showing you some solutions which are given by participants. Now one of the solutions which is very common is that okay, buy 400 quantity of 17,900 call, which is the most, you can say, simplistic solution for this kind of a problem. Now what happens, we have added this row, call buy 17,900, because we are buying, so positive sign is used. Delta of this call is this much. So what has happened with this? So we need to check again the health of the trade, and what is the impact on the trade with this kind of a solution. uh, Delta has become positive. First thing is, we would not like to have a very positive delta. This is a positive delta, so uh, something is missing. This is not a healthy trade, because in case from here markets dips down, it will not be very good for the trade. Second problem, which is the bigger problem, my theta has reduced by almost 50%. Just one day in the setup, market has just moved by 150 points. Very next day, I have taken an adjustment in which I have almost given away 50% of my possible profit. Theta is a possible profit for option seller, which is not a healthy situation, right? This is not good. Theta has reduced by almost 50% from 25,2600. It has become 13,1400. So that is not great. Third parameter on which we need to check any adjustment is that whether margin requirement has increased. In this case, obviously, margin requirement will not increase. Rather, it will decrease. But that is not the point here. The point is that okay, I have given up the trade almost by 50%. Whatever is my theta decay on the sold call of 17,800, most of that I have given away in 17,900, right? So not a great solution. Secondly, delta becoming positive is also not a great solution. Even now the delta is not neutral, right? So this is the first solution, and most commonly followed solution, which is very simple also, but then hopefully all of you know what are the repercussions. Already we have given away 50% of possible profit back to the market. And let me tell you, in case market goes down, this buy call will decay pretty fast. It will decay pretty fast, and it may not give me many opportunities to recover my money. By even if I say that okay, suppose market next day goes down by 150 points, I will remove this call. By that time this call will be doing a decent damage, right? So this is the reason I'll say solution one may not be the best solution for this kind of a trade at this stage of the market. So Another solution, which is second solution for this, is since we were leaving a lot of theta in 17,900 when we were purchasing 400 units of 17,900, we said, okay, why to leave that much of theta? Instead of buying 17,900 calls, in this, what we have done, we have purchased 18,000 strike price, but we have purchased same 400 quantity. So let us see what has happened with this. Delta has become positive, but it's almost neutral. It's much better than what it was in solution 1. But again, what has happened is we have reduced our theta almost by 35%. Now, this is the first day of our trading, or you can say second day of our trading. So we have to, this is a positional trade, and we have to do this, we have to maintain this trade for 10 to 20 trading days. We cannot surrender 35 to 40 to 50% of our possible profit just in single move of the market. So again, reducing theta by 35% is not a great move. So another reasoning which is generally given by many of us, that okay, in case market moves down, I will not allow this call of 18,000 to become zero, and I will immediately square it off. But the problem is, whenever you are buying a call, once the sold call has started giving loss, it is always difficult. So in case market from here goes down, delta in any case will be working against me, and this call of 18,000 will melt pretty fast. So in that case also, whatever our initial theta was there, we will never be able to cover that theta. Margin wise, this is the similar solution, so no issue, but definitely still the kind of theta we have reduced with just one single move of the market is not at all desirable. So can we have any other solution? Let us go ahead and see what is a possible third solution to this situation. Okay, the possible third solution to this situation is that okay, we sell another 8 lots of 16,900 put. So if we do that, what will happen? The delta will almost come in a very narrow range, which is good for the trade. It is still negative also. Theta has increased phenomenally. So this is definitely an excellent adjustment. Sell extra 400 quantity of 16,900 puts. Right, so delta is almost neutralized, theta has increased by almost 47-48%. But where lies the problem lies, you see, margin requirement. If you want to sell extra 8 lots of 16,900 instead of 8 lakh rupees, now you may be requiring 14 lakh rupees, right? So retail trader is this solution may be good for somebody having a lot of exposure to funds, and he's bothered about how much fund is required, but he is keen on saving his position of 17,800. But a normal retail trader generally has a limited fund, and whenever we trade with such a conviction that okay, major portion of our fund we put right in the first. Right now, in this case, also this trader A, he had 9 lakh rupees and already 8 lakh something, 8 plus 1 or 8 lakh 10,000 rupees he has already used. So where from he will bring this kind of a margin? And secondly, in any situation, if you are doing an adjustment by bringing tons of money into the system, uh, it's a no-brainer, right? It's not something we can do every time. Now from here also, if market moves, will it be possible for us to sell another 8 lots of 16,900 or 70? So this is not a great solution when for every drop of a hat I need to increase my capital requirements, right? So based on this capital requirements situation, I'll say no. Again, I would not agree for this solution. Although if you see, it has done good job on theta front, but then at what cost? Whether that kind of money is available to me or not. It has done wonderfully well on delta front also. It has done well on theta front also. But where from I will bring money? So we say, okay, let us see what else can we do. Now we are experiencing a kind of a practical situation which almost always happens with us, that okay, we have created a trade, and as soon as we have created a trade, market starts moving, and we really do not have uh, any control on these kind of situations. Let's see another possible solution. You might also be having many solutions. uh, Another solution is, okay, let me shift my 16,900 ports up and take them to 17,200 port. Right, in this case, what we have done, shifting means we have squared off our 16,900 ports, and we have shifted all these puts to 17,200. So now the trade is 17,200 put sold, 17,800 call sold. Now result is delta is pretty good, although still slightly far away from being neutral. Theta has increased by almost 20%. Margin requirement not much change. So is this the best solution? Again, I'll say this may not be the best solution because this is just day 2 of the series. We have started the trade with a gap of almost 900 points, 17,800 to 16,900. So the width of the trade was pretty good. Market has moved by only 150 points. We are only 1 day old with this trade in the market, and with just with 150 points, what we have done, we have surrendered 300 points of width to the market. Now our trade is 70,800, 70,200. So the gap, the width between the trade is only 600 points, which is low. It's not that okay, we are sitting on the 15th day. We are sitting on the first day. Market has moved up, and market has moved up by only 150 points, but we have surrendered 300 points to the. Need to take care of this. That okay, ultimately I have to live with this trade for some days. I cannot just spoil the trade on the first instance. So if I've converged all the distance with just one move of the market, then also it's not a great adjustment. Although on theta front it's doing well, margin requirement not changing much, delta is sufficiently good, right? But still, I do not want that. Okay, market has moved by 150 points, and I have converged my position by 300 points. So this is another factor which we need to see. So we have seen 4 solutions, and although all the solutions, if you see as a simple trader's perspective, all the solutions are achieving some kind of delta neutrality. But then by achieving that delta neutrality, what is the repercussion on my other health parameters of the trade? What is happening to my margin requirement? What is happening to the width of the trade? What is happening to theta? All those things also need to be considered. So what is the generally aim of doing an adjustment? I'm talking again about a strategy which is initiated as a delta neutral strategy. In delta neutral strategies, you always try to take money, make money by theta decay. But yes, market is market. It cannot remain at one level. It will obviously move. So whatever plan we make, we need to take care of. So whenever market moves, what kind of adjustment we should be doing, whether it was solution 1, whether 2, whether 3, whether 4. So for that, let us see what is the aim of adjustment. Aim of doing adjustment once market has moved is that we need to bring delta as close to neutral as possible. That is perfectly all right. Most of us are able to do that in all the solutions we have given to you. No negative impact on theta. We would not like to see that okay, we are giving away 30-40% of theta with just one adjustment. If required at a later stage, yes, we can leave it. But if we are surrendering the theta too early in the trade, then there will be a situation that okay, we will not be left with theta. Then we will be working only for reduction of losses rather than making any profits. No significant increase in capital required. My capital requirement should also not jump manifold. That is not a great adjustment. Once in a while, yes, that can be done, but it cannot be adopted as a process. And then do not leave the space in the trade. I do not want to come very close to the market just in the initial days of the series. Yes, there's a later day of the series when the premiums have already decayed. I always have a choice whether to converge my trade or whether to take away my profit and book profits and get out of the trade, but not in the initial days of the series. So these are the aims of doing an adjustment. And what we have seen in the previous adjustments, somewhere at least one of these things is not getting fulfilled. Things are becoming slightly complex. So let me present to you one of the another solutions. Let me give you solution number 5, in which we have tried to achieve all these things. So whenever we are trading, we need to have a plan that okay, if these things happen, what kind of adjustment we will be doing. It's not possible that okay, once the market has moved, at that point in time we start seeing the possible options with us and then seeing the permutation combinations. No, we should be ready with the adjustment, what adjustment we will do, at what point in time we will be initiating this kind of adjustment. So this is by far one of the best adjustments what I'm showing you on the screen. So what we have done, we have shifted the losing side by 100 points and we have shifted the winning side by 200 points. So what we have done, we have shifted 17,800 call to 17,900 call, and we have shifted 16,900 put to 17,100. Now the question comes, why we have shifted the put side by 200 points, whereas we have shifted the call side by only 100 points. You see, if you shift the call side by 100 points and shift the put side also by 100 points, you will not be able to get the desired premium. Whatever you're giving to the market, you may not be able to take away that premium from the market. And secondly, you will be still leaving some theta. So on losing side, we have to leave a little bit of theta, and almost equivalent amount of theta we need to gain on the winning side. Winning side means because market is going up, we are a put seller, so that means that side is a winning side for us. So in this solution, what has happened now, our delta is almost neutral. It cannot be better than this, right? Theta, there is no negative impact at all. We have not uh, given away any theta to the market. Okay, market has moved 150 points, it's perfectly okay with us. No change in the margin requirement. Margin requirement will remain same. Width of the position, earlier we started with, let us say, around 900 points, and now we have a trade 17,900, 17,100. So market has moved by 150 points, but I have given away only 100 points width to the market. I have converged my width only by 100 points. So if I am starting with, let's say, 900 points, and with every adjustment I am giving away 100 points to the market, that means I can still have 9 adjustments in the market. And see the magic. I have given away 100 points to the width to the market when market has moved by 150 points. So in case market moves by 900 into 1.5, which boils down to something like 1300, 1400 points, only then what will happen, I will surrender all my width, and my short strangle will become something like short straddle. Chances of market moving unidirectionally, or although whatever we have seen in last few weeks or few months, market has moved, but still chances of that happening are low, because in that process there will be some decay also, and there will be some opportunities to book profits also. So here what we have done, we have kept our delta perfectly very close to zero. We are not affecting our theta at all. We are not increasing the margin at a drop of a hat, and we are keeping a very healthy position rate. So hopefully you must have liked the solution. In this way, what has happened is you can manage n number of trades. I have given you a very simplistic example where there are only 2 line items, where there is only one set of sold calls, there is one set of sold puts. There are only 2 positions, you can say, right? But there can be multiple positions which are open positions, which are not a part of any closed strategy. Still, all those positions, ultimately you can see, you can put all those positions into maybe an OPSTRA, and then you see, okay, what is the final Greek value, what is my final delta, what is my final theta. Now if my delta is trying to disturb things, then okay, I want to neutralize my delta. Sometimes you can add on some buying also, little bit of buying, so that the theta doesn't get affected to a large extent. So ultimate aim is that, okay, neutralize delta and maximize theta, right? Maximize theta doesn't mean that, okay, we go overboard and we bring positions very close. Maintain the width of the trade also, and that also doesn't mean that, okay, I'm increasing the positions too much, right? So other benefits of proper Greeks management is trade has not become complex with additional line items. Many times I've seen, just to make delta neutral, just not to lose theta, many experienced traders keep on adding some legs, a buying here, a selling there, a buying, and then maybe a further selling, and that may not have a much impact on margin with new margin rules, but the trade becomes too complex, right? It becomes too complex. A 2 leg trade becomes a 4 leg or 5 leg trade with 1 or 2 adjustments. That is not desirable. In this kind of adjustment, calculations remain easier, although with the usage of OPSTRA, calculations are always easier. We are not required to do anything, it's automatically calculates everything. But again, if you have only 2 line items on your screen and things look as if they are well within control compared to a situation when you have 6 line items and you really do not know which line item, which position will impact my overall Greeks in what manner, right? So things are out of control if there are too many line items in a single trade. And with the market moves, scope of further adjustment is always there because we have not given away width in any of the simple adjustments. We are too quickly giving away the width of our trade. So that reduces the scope of further adjustments, because nobody can say that okay, market after moving by 150 points will become very stable. It can further go by 150 points, it can come down by 300 points. So that way it's like always balancing your positions. And how to do that, I have given you out of 5 ways, one of the ways which work really well. You see, managing your delta theta is basically like managing how to ride a bicycle. Now in case of your bicycle, if the front tire diameter and the rear tire diameter are not similar, it will be very difficult to ride that bicycle. If the front tire diameter uh, gets reduced, then we will be falling on the front side, and if the reverse tire diameter is getting reduced compared to the front tire, we can fall on the back side. So it's again a balancing act. Similarly here also we are trying to do a balancing act, that okay, the kind of delta we are getting from the call side is to an extent similar to kind of delta we are getting on the put side, and we are not having any negative impact on the theta. And if we are into the trade for some days, obviously that theta, the coins of theta will keep on coming into our bag, and we will be sitting at a decent profit. And after that, there can be many other adjustments done to make the trade a closed trade rather than keeping it as an open trade till end. What about Vega? So generally we are not in a position to control implied volatility or wicks of the market. It can go up, it can go down. If obviously we are looking for some big event, right? If there is a known event, then obviously we know that implied volatility from here will go up. Then obviously we need to keep trades which are not having very high negative vega, because if the implied volatility increases, it will create problems for us, right? So based on whatever is the employed volatility as of now, maybe we can use IVP, or if you are experienced trader in a particular underlying, you can just see wicks, and you can say okay, if the wicks is 11 12, it's not on a higher side, it's definitely on a lower side. So when wicks is low, instead of using Vega negative strategies, we need to use Vega positive strategies. Now, the strategy which I've shown you was sort of a short strangle. It was a short strangle, and short strangle will have a negative Vega, right? So when VIX is low, that time we will use Vega positive strategies, because what is VIX? VIX also has a nature of reverting back to its mean. So if it is low, it will become high. If it is high, it will again come back to low. Then this journey from high to low can be 1 month, can be 2 months, can be year also, you never know, right? So if VIX is low, so what I'm trying to say, delta and theta we can actively manage. As far as Vega is concerned, while doing the selection of the trade, we should see what is VIX. If VIX is low, let's go for Vega positive strategies. What are Vega positive strategies? Buying a call, buying a put, buying both, calendar spreads, diagonal spreads. These are all Vega positive strategies. In case the VIX of the market goes up after I have done the trade, these strategies will give us good effects of Vega. And if we find that okay, VIX is high, generally when you are into trades of Nifty, any VIX which is above 18, 19, 20, it is considered as high. That time obviously we expect that okay, now VIX has gone higher. Ultimately, since it's mean reverting, it will go back to low, so we can take Vega negative strategy. So one of the ways to control Vega is, yes, you can decide on the trade based on what is the VIX right now. So this is the third parameter, third Greek which we were talking about. Otherwise, now Indian markets, you see, we do not have earlier we had a future of VIX which was there in markets for few days, and ultimately it couldn't catch up to any kind of heavy trading. But what happens generally when you're doing a trade like short straddle or short strangle, which are negative vega trades, you do not want to take implied volatility risk. So what you will do, you will buy VIX, you will buy a future of VIX. Unfortunately, in our Indian markets, that future of VIX is now not available, or options of VIX are not available. Otherwise, you can always buy VIX, and in case VIX will go up, your future will go up, and your other short strangle will give you your theta value. So that is another possibility. Another possibility is that okay, you create combination of strategies. You can combine your low VIX strategy, negative vega strategy with a positive vega strategy to nullify the impacts of implied volatility. But that in itself is a big Pandora box. So we will talk about those details uh, next time. So what I feel, right, option trade management is basically a game of chess. It is a sum total of small but multiple right moves. Little moves in the market, converging your distance by only 100 or 50 points will give you a lot of scope in the trade, and you can be in the trade for a few days. And for any open trade, it's just a question of being in the trade for some days, and ultimately the trade will be almost always profitable for you. So if we can use our Greeks in a right manner, I think there are very few situations where we will be in trouble. Even if we are into trouble in few situations, we can come out of those situations by rolling over our trades to maybe further expiries, right? So hopefully this must have given you an idea how to practically use these uh, Greeks, right? And these are some of my details. I'm co-founder of Option School. Contact details are there. We have Twitter handle is there at the Option School. We have a Facebook page also, and then we have a YouTube channel. We have our website also. So thanks for very patiently listening to me. Raghu, this is from my side. If we have few more questions, we
Yes.
can take care of that.
Okay. Thanks, Pradeep, a lot. I mean, this was, I learned something new today because I also do a lot of adjustments. And today I learned something new, how to counteract the theta and the delta and how to manage them, and without giving up any of the width of the triangle or the theta. And it's a quite new learning for me. So folks, so Mr. Pradeep has given his contact details, and if you have any queries, you can contact him on these details. But I have my own queries from the perspective of new traders. So I'll be asking those questions. But if you have any other queries apart from that, then you can contact Mr. Pradeep Kumar using these contact details. And there are a treasure trove of information in his YouTube videos, which I also view from time to time. So I recommend that you also go to his YouTube channel and learn something new from those videos. So Pradeep, coming back to the presentation, uh,
Right.
so you have shown this solution 5 to manage the strangle if it goes in one particular direction, right? And from
Right.
what I know, most experienced traders, and even I used to do this, we used to use the solution 4, is to just move the put side. If the market goes up, we used to move the put strike by, like 300 points or 200 points, like that. Uh,
Right.
so, and as you have clearly shown that that it has some disadvantage there in terms of giving up the width,
Right.
and therefore the solution 5 is a much better solution because there you're not giving up your width a lot, and at the same time you're
Right.
not giving up your theta also. So this is a very
Right.
elegant solution, a very elegant solution, I would say, because this is something new I've never seen anywhere. So why my question here is, now let's say that the market has moved by 150 points and we have deployed the solution 5. Okay.
Right.
And what happens if the market comes back by 150 points? Then what will you do?
So again, Raghu, the classic case, generally this happens, right? Practically, this happens
Yes.
because you are involved in markets. You know this. It's a fantastic question. You see, if market has gone up, I have given away, let us say, 100 points in my trade, and let's say market is pretty much volatile. Now, any adjustment you do, you never know whether this adjustment is going to be good or bad. You never know this, right? But that
Yeah.
doesn't mean that okay, I allow my trade to go scot free. I cannot allow my delta to be very high. So in our workshops we talk about some golden ratio of delta theta and all that stuff. But yes, your question is, in case market has gone up by 150 points and now market comes down by 150 points, again based on what is the impact on my delta and on theta, because in doing that it might be possible that market has passed another 3 4 days, or
Yeah.
market has done it very next day also. So then we can
Mhm.
again reverse the transaction. We can say that okay, shift your losing side. In that case, your put will be a losing side. Shift that losing side by 100 points. So from in this case, from 17,100, we can shift it to 17,000, and call side from 17,900 to 17,700. So shift your
Okay.
winning side by 200 points. Shift your losing by 100 points. You are again converging your position by 100 points. But still, you
Okay.
have a decent gap available with us.
Okay. So based on, I mean, if you follow this solution 5, depending on how
Right.
market moves and by how much, then as there are more adjustments, you slowly converge to into a straddle
You keep on
at some point
converging
of
the
time.
position. Yeah, you expect that okay, you expect that okay, by the time you're converging your short strangle into a straddle, you're pretty close to expiring. Because ultimately it's like a test match. If you can stay on
Yeah.
the wicket, then runs will automatically come.
Yes. So another question related to solution 5 is that we have seen this in the recent market, like in last 2, 3, 4, 5 weeks, that market has gone up only one way, and it didn't
Right,
even correct a little bit. So
right,
using your solution 5, then we have to keep adjusting every time the market has moved up, right?
right,
So how
right.
would you, again, so it depends on delta or theta. I mean, you can tell the viewers how would one go about that.
So it's again, you see, when you're doing this fusion, one thing I will say, Raghu, I have not shown you any premiums. We are not,
Yes.
what exactly viewer market trader is seeing is, he is seeing premiums, that okay, my call is worth 50 rupees, my put is worth 60 rupees, my total premium received is 110 rupees, right? Now let us say in this example we have received a premium of 100 rupees. Now if market is moving in one direction, we can keep on shifting the positions. At some point in time, what I will do, if I'm shifting my put by 200 points, I will shift my call also by 200 points, so that I'm not at all converging the position. In that case, it's quite possible that okay, instead of having 100 rupees credit, I may have to leave a credit of 10 to 15 rupees. Instead of 100, now I'm having 80 rupees credit. So
Okay.
ultimately it all depends how market behaves. I'm okay leaving the credit also. that
Yeah.
that credit is an extra thing which is available to us. So generally what I have seen, if I am sticking too much to that credit, that okay, I have
Mhm.
given markets and I've taken 100 rupees from market, I should maintain 100 rupees. And in these kind of market moves, things get slightly messy. But if I'm ready
Yeah.
to forego some rate, you see, you are not here that okay, if I've done a short strangle, I will take away last penny from the trade. A good trader generally takes 40 to 50% of whatever is the premium available. So that
Yeah.
means I can still surrender 50% of my premium. So if I'm ready to surrender that premium, at a later stage also, I have converged the position. I can again add a little bit of more width. But yes, definitely easier said than done. But another thing is, Raghu, by the time the width is getting converged, obviously some days will pass, and in that case, if you need to do a buying of call, let's say we are talking about a scenario where market is moving up. So in that
Yeah.
case, if you need to do a buying of call, that will be much cheaper if you're doing it on first or if you're doing it on 12th, right?
Yes.
For 11 12 days, at least the money you will be foregoing in buying that call will be much lesser. And
Yes.
if you see, again, we said important decision is whether I should be doing a short strangle in these kind of markets or not. So Vega, if we see last 15 days, employed volatility available was too low that okay, I will be not a very intelligent trader if I'm putting up my money on short strangles.
Yeah.
Premium available was pretty low and the market moves are pretty high, right? So generally at 11 or 12 or 13 kind of weeks, we will not be entering into these kind of trades. So if you have entered these trades at 18 or 19 or 20, we will get healthy premium, we will get healthy distance also. I am too much used to doing a short strangle. I know at some stage in my life, my many friends used to call me short strangle only. So
Okay.
even now I have short strangles, but those short strangles are something like 18,500 and 15,800 of October. So I think I'm not very greedy. I'm not looking for some 10% kind of a return. If I'm looking for lesser return and if I'm not getting that kind of a good premium in current month, it makes absolute sense to widen your trade on expiry part also. Instead of doing it in the current expiry, we can do it on the next expiry also. So that is one of the reasons, but I will never compromise on the width of the trade as far as when we are initiating the trade. As you rightly said, market can become unidirectional, right? So those
Yeah.
months are definitely difficult months.
Okay. So Pradeep, have you faced any situation where, despite doing so many adjustments, the market went in one direction? Have you faced a scenario where you said that, okay, I mean, now I cannot manage anymore? That, I have to
Right.
compromise and give up the trade or take the loss. Like, so using this solution 5, have you faced this scenario last year? Let's take an example in the last 1 year. Have you faced this scenario how many times?
I will not say we have faced this scenario many times, but yes, I will not say that okay, it was a cakewalk also. You see, earning money is not easy, Raghu, right? So whether
Yes.
it's options trading or whether it's any business, there will be
Yeah.
stressful moments, but you have to
Yes.
stick to the trade. So
Yeah.
what we do generally, you see, I will say uh, 30 to 40% of trades will face some stressful situation. One
Mm.
of the alternatives, what we find that okay, if we find that okay, the distance is getting too converged, we are not able to maintain the premiums, we have two three other methods, in which one of the simplest method is we roll over the position to next month and we again get a 500 600 points extra distance, right? If this month
Okay.
call is, let us say, 200 rupees, next month 300 strike price away, call will be at the same price. So what we do, we forego some time also. So if you are going to earn that 1 lakh rupees in this month, we may not earn this month, but ultimately we need to protect our capital. It
Mm.
may be possible that okay, for 3 4 months you're not you see what happens, it happened to me also in my initial journey also. You earn money for 5 months and you
Yeah.
lose much more than that for balance 5 months, right?
Yeah.
So that should not be the case. So my first principle is I'm not going to lose it in a trade. So even if I have to, I have seen a situation where I kept on shifting my trade from August to September, October, November, December until January. I have to do a lot of rollover. But ultimately in January, I was able to get out of that position profitably. So yes,
Okay.
sometimes in stressful situations you have to do that, but then you have a confidence that okay, whatever happens to the market, I am going to
Mm.
deal with it somehow. So that gives you, you see why people put more money on fixed deposits or in banks, because there is a sort of a guarantee that my principal will not get disturbed. Right.
Yeah.
In stock markets, if I start with 10 lakh rupees, it might so happen in a position like short strangle that 15 days down the line, my 10 lakhs is now worth 5 lakhs only.
Yeah.
So if you have a process in place that okay, at least I'm not going to allow this 10 lakh to get reduced by even 50,000 rupees, it may take me 2 months, it may take me 3 months. You see, Raghu, otherwise also you buy a share. Let us say you buy a share of Reliance at its highest value. Let's say we buy it at 2300, and in next
Mm.
3 months it goes down to 1800 1900. What can we do? We cannot do anything, just wait, and we are not
Right.
recovering money also. So in options, the advantage is that okay, if you are able to delay the trade a bit, if you can pass more time on the pitch, then chances are I have seen worst of the trades coming back to break even or profitable within 2 to 3 months in worst of the markets.
Okay. Okay. Yeah. I mean, that makes sense. So, so in that case, then your solution 5, can it be employed in weeklies? Is it possible to employ in weeklies? Because from what what my conversation tells that you do mostly in monthlies. So have you tried this in
I do
weeklies?
mostly in monthlies. But weeklies, I will say, now the gap between two strike prices, let us say 70,800 and 70,900. When it come to monthly, if 70,800 is 100 rupees, 70,900 will be 80, 85 rupees or 75 rupees. What happens in weekly, you do not get sufficient time to act sometimes. The one of the position, maybe the sold put, or in this scenario when markets are moving up, the sold call suddenly increases so much, the gamma effect,
Yeah.
that okay, now if you roll it up, you will be losing more on the call side, and you will not be able to recover those things on the put side. I'll say weekly, I would not say this is very advisable, but for second month, for third month, or maybe for December end, this is really advisable. You need time. You do not want to
Yeah.
land up into a situation where one of the position has given so much of loss, the other position is not able to cover it also. So I will never
Yeah.
suggest this kind of a thing in a weekly based on whatever we have done today. Because if you want to adjust Greeks practically, we need time also. Sometimes
Yes.
weekly trades do not give you that kind of a time, and you're not able to collect decent premiums at 1,000 points. At 1,000 points width, the premium available at this IV will be hardly 10 rupees, 15 rupees. But risk is equally high. So I would
Yeah.
say we have a formula that okay, at least minimum this kind of a premium should be available. Only then we should do a short triangle of 800, 900 points width. So we want minimum 100 rupees from the trade, and the width should not be less than 900 points. I can always collect 100 rupees from the trade with a width of 400 points on a monthly trade. But we have made some kind of a basic rules that okay, at least the width should be 900,000 points. Only then collecting 100 rupees means I have another 100 rupees width. So if at 900 points I've collected 100 rupees, that means my safety is for 1,000 points, and it will give me some opportunity to do some jugglery on my positions. And this may not be the only adjustment.
Yeah.
Again, if required, you can flow in more money. You can follow solution 4 also partially into the trades. We can follow solution 1 also if we think that okay, what happened in March 2020? Markets were going down anything. That time I had positions of 12,400 and 11,400. And when market started drifting down, Raghu, at one point in time, when my 11,400 was coming in the money, we immediately purchased 11,300 posts. That time it was required because the way market was
Yes.
behaving. And
Yes.
market from there went down to as low as I think 9,000 or something. But still in
9,000.
these kind of trades, we booked a little bit of profit. Because once my
Yeah.
puts are locked, I can keep on bringing my call down to any levels. So I'm not
Okay.
saying this is the holy grail and this is the only method available,
Yeah.
but this is one of the methods which at least 80 to 90% of times works slightly better than any other methods of doing an adjustment.
Okay. Okay. So there will be times at times where we also need to buy hedge in extreme situations, like when the VIX is
Right.
exploding. So that
Right.
times we have to buy hedge to protect your strangle, or either exit
Right.
the position to protect your capital. So I think that's what you're
Right.
referring to. What has happened in March 2020, right?
Right. Right. When you
Okay.
saw the VIX has gone to as high as 84, right? At
Yeah.
that time,
Yeah.
you cannot be sitting at a very close position with
Yeah.
500 points. But once the VIX is 84, Raghu, you can create this short strangle, giving you 100 to 120 rupees, even at a gap of 4,000 points.
Yes. Yes.
So that time, a new opportunity is there. But what to do with your
Yes.
existing trade is a challenge.
Yeah. Yes. Yeah. I mean, this is what my preference was usually to short when the short the strangles or any other short volatility strategies when the volatility is coming down. Like when you said it's
Right.
84, that was the
Right.
nice time when it is coming down, where even you get
Right.
large width, yeah, with very good premiums. Yeah,
Very good premiums.
yeah, very good premiums. So, uh, so in the perspective of VIX, you already talked about, low wicks and high wicks situation. So what is your take, at this point of time, when the wicks is very low, like last 2 weeks ago, the wicks was around 13 or 12, something like that. So do you avoid this kind of strangles at this point of time, or you buy hedge and then you do combination of strategies? How do you manage
So
at low wicks
if
levels?
the trades which we are doing mostly at low wicks levels are generally calendar spreads, right?
Okay.
Calendar spreads tend to gain because wicks is again something, a phenomenon which is mean reverting, right? So
Yeah.
wicks, if it is 11 12, there is a chance that okay, maybe 2 months down the line or maybe 2 weeks down the line, it again
Yeah.
reverts back to 18 19 17. So in those cases,
Okay.
positive vega strategies are calendar spreads and diagonal spreads. We are focusing more on that. But yes, you see, once you're a trader, you always have a habit of doing some short strangles, because short strangles
Yes.
are most rewarding strategies. So in those
Yes.
cases, what we are doing, instead of doing a pure short strangle, it can be a form of a double calendar spread or a double diagonal spread, wherein you buy some cheap protections, and then you
Okay.
do not expect too much of money from the trade. So when I say that
Okay.
VIX is low, then can you do an iron condor or iron butterfly? What I found that okay, iron butterfly was one of the strategies which was fantastic strategy when VIX was 30, 40 or 80 also, and it's a decently good strategy even when VIX is 12. Only thing
Yeah.
is, if you can combine those iron butterflies with few of, maybe you have done 5 iron butterflies, and to reduce the impact of increase in VIX, for every 5 iron butterflies I can have 2 calendar spreads. So those kind
Okay.
of combinations wherein we are trying to reduce the risk of VIX on the trade are definitely possible. And but yes, you have to sit slightly longer, and you have to rationalize your expectations from the trades. When obviously when premium available is low, you cannot
Yeah.
say that okay, I want this kind of profit from the markets. It has to be low. And
Okay.
for a non-directional trader, since we are not chasing the direction of the market, yes, there will be a definite reduction in the kind of profits we will have.
Okay. So in a way, when the VIX is low, you reduce your position size with your strangles, and you add something extra for the positive VIX strategies.
Right. Yes.
Okay. 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 Thanks, Pradeep. I mean, it was very nice. I really liked your adjustment, that solution 5. And this I've not seen anywhere else. This was first time even for me. And I think the viewers of this talk will take some lesson away on how to adjust your strangles, and also use the knowledge of Greeks, of the both delta, theta, and how to adjust accordingly to manage the delta and theta. So Pradeep has given very nice scenarios, different scenarios, not just one, different solutions on how to manage these things. And I think it's wonderful. And for me, I'm very happy to see that solution 5, and I might deploy that kind of solution 5 in my trading as well. So I hope the viewers take away a very good lesson from this talk, and I deeply thank Mr. Pradeep for agreeing to give this talk. Thanks a lot, Pradeep, for accepting the invitation to EDECNOCH 2021. I hope to see you again in some other conference soon.
Thanks. Most welcome. So nice of you, Raghu. I have learned a lot of things from you, a lot of things from your software, and I'm always thankful to you for providing such a wonderful. You see, let me just take another 1 second from. A few years back, I was also in a process of creating some automated system which can calculate these deltas, thetas, position Greeks for me, and there were hardly any solutions. We used to have an Excel sheet which we used to refresh every time. So, but once I got used to OPSTRA, I think now trading without OPSTRA becomes a difficulty. So we are to an extent dependent on OPSTRA also, right? But a wonderful tool you have provided to the market, that is a big contribution to trader community by you. So nice of you. Thanks to you for that.
Thanks a lot. You're being very generous,
Mm.
and thanks a lot. So see you another time again. Thank you.
Thank you. Thank you. So nice of you, Raghu. Thank you.